Hello, welcome everyone to the final webinar of the RiskMinds Digital Week. Over the course of this week, we've had an expert insights on topics from IFRS 9 to FRTB, and now we take a final look at recovery and resolution. I'm Ed Stapley, Editor-in-Chief of RiskMinds, and I'd like to welcome today Daniel Willam, Head of Resolution and Structural Reform within Treasury at Deutsche Bank. Daniel will be discussing how companies can find the right setup of data, processes, and external counterparties, and will also be with us at RiskMinds International in Amsterdam later this year in December for the main conference. So we'll be live tweeting this webinar. You can join in the conversation using the hashtag RiskMindsLive. And if you've got any questions at all during this webinar, do submit those, because we'll be asking them at the end, and you can submit those using the green Ask a Question tab on the left-hand side of your screen. So as a question comes to mind, do pop that down, and I will ask it at the end. So over to you, Daniel. Thanks very much for joining us, and looking forward to your talk.
Yeah, thank you very much, Ed, and thanks for inviting me to speak here at this RiskMinds webinar series. So perhaps two things up front before I start my presentation. The first remark is that I'm going to share some of the insight that we've gained as Deutsche Bank from this process. But this is really just reflecting our own experience, so please don't see it as any advice for your own initiatives and projects. And the second point I want to make sure is I do apologize for all of the acronyms and all the buzzwords that I used throughout the presentation. And there's always a fine balance between finding the right terminology for some people that are familiar with the topic and people who are relatively new to it. So I'll try to explain everything while I speak. Starting with the buzzwords, though, we already have the first two here on the front page, so bail-in and operationalization. So what does it mean? So bail-in refers to a measure by which banks are resolved in case they fail. So looking back at the financial crisis in 2008, at that time, a lot of banks failed, and then governments actually stepped in to rescue these banks by injecting capital into these banks, and that was called bailout. And as a lesson of the financial crisis, it was said that this shouldn't happen again. And now, in case of a bank failure, the burden should be on the existing debt holders of the bank, and that is called bail-in. Operationalization refers to the term to prepare, the entire process and making this bail-in possible. And as we will see, this is actually quite a large project for all of the banks, but also for the regulators who work with the banks. So moving to the first slide in the presentation, this again shows the process that we envisage here at Deutsche Bank for such a bail-in process to work. So in broad terms, what is a bail-in? You currently have debt instruments that are issued by banks, and during this bail-in process, these debt instruments will be written down. And then in exchange for that, you will create new share capital that will be assigned to these debt holders. So in essence, what it means is that you do a debt to equity swap, and therefore the debt holders become the new shareholders of the bank. The bank in turn is recapitalized and therefore can continue its bank operations. The way it works is that typically the bank enters into a period of stress and is monitored by its regulator and resolution authority. And then at some point, the resolution authority sort of pulls the plug, so it says, no way further, and says the bank is not viable anymore, which is the point of non-viability. And then what you have is the infamous resolution weekend, so that essentially throughout this weekend period, you have to finalize the entire process so the bank can reopen on Monday morning and is already a recapitalized bank. There's a legal framework that deals with bank resolution, with the bail-in, and that says that there's a requirement for doing valuations, and that has to be done typically before the point of viability. And so that's what you see on the chart here. So, the week, let's say up to Friday evening, the bank is already under stress, and therefore you already start these valuation processes for the financial, franchise, and insolvency valuation, and I'll explain later what that really means in detail. But then, you see that the bank actually has incurred a lot of loss, and therefore you have to really trigger the bail-in process. And then you have to calculate as the bank the bail-in capacity, so how much liabilities do you have that you can convert into equity. And then you have to calculate the conversion rates. Conversion rates here refers to the term that you have to know how many shares and at which share price you have to allocate to each single bondholder. From that point, once the conversion rates are set, you enter into the execution mode. So that really means that you have done the theoretical thinking about what the recapitalization should look like, but that needs to be executed. So the first step is to do it internally, and that starts with the internal bond write-down. So you look at your own systems where you have captured all the liabilities that you have, and you have to write them down. And then, of course, in a second step, you have to recognize the capital internally also in your financial accounts. That means that then by, let's say, Sunday or whenever that's done, the bank is internally in its own systems is recapitalized. But then starting Monday morning, you have to start the external execution. That starts with the process of rehedging. Now, what does rehedging mean? Right now, typically, banks swap their interest rate risk to turn it from a fixed rate risk to floating. So in simple terms, if you issue bonds, you have a fixed rate coupon, but banks want to steer their own interest rate risk on a floating basis, so they swap this into a floating rate, basically exposure. Now, of course, once you do the bail-in, the bond doesn't exist anymore, but you still have to swap, so therefore you have to rehedge this exposure, and that is the process of rehedging. So that's one thing that the bank has to do, but of course, what's more important is the point of view of investors. So investors still hold the bond in their securities portfolios, and that needs to be written down so that once they basically check their securities account again, they don't have the bond in their securities account anymore, but the actual share. So for that, the share needs to be created first, and the share needs to be delivered to these securities accounts of these bondholders. And I'll explain in a second how that works. In short, you will use the network of CSDs, and that's the central securities depositories like Clearstream and Euroclear. You use this financial market infrastructure to basically trigger off the chain of events that ultimately the custody banks that holds your bonds will then also basically book the shares into your accounts. But again, some more details to come. So as you see, that's a tremendous process that has to be triggered, and all of that has to be done over a very short period of time. And I think the key challenge is that all of these points have to be thought through upfront. You have to document each process step upfront because the process has to work once it's really triggered, and mistakes shouldn't really happen at that time because that can be fatal in that kind of situation. And of course, the key issue that we have right now is the bail-in hasn't really been tested before. So a lot of this thinking is still theoretical, and I think it still needs some more time to really find the practical applications and lessons learned from this. So how have we tackled this entire problem here at Deutsche Bank? So we have divided the entire process into several process steps, and each process step is a sub-project in itself. So we have at the end these 6, let's say, work streams and sub-projects. And in the following, I'm going to go through each work stream one by one to explain how we've approached each single issue. I think just in summary, it's fair to say that bail-in covers a lot of different aspects. So on the one hand, work streams 1 and 2, which are about the financial infrastructure, about the reporting and the data, that's very much IT driven, and you have to have a lot of involvement from your local finance colleagues. Workstream 3 and 4 are a lot about theoretical concepts, so you have to really find first some approaches how to come up with solutions before you can really do an implementation. And then projects 5 and 6, this is a lot of documentary work where you have to capture a lot of data, a lot of processes and work streams. You have to appoint roles and responsibilities and so on. So the entire bail-in process and the preparation for itself is a very broad-based topic here. And I think it's fair to say that you need to involve a lot of experts from across the bank. In our case, this is a project that has involved more than 250 people. Of course, those didn't work full-time on this project. Some of them just had one small task as an expert, but it just shows that there's a really wide range of experts that you need to involve in order to make this bail-in preparation successful. So starting with workstream 1, to give you more details on that, that's what we call reporting. And that really deals with the data about the liabilities that you want to bail in. So typically the bank has a capital stack, which is equity. It has subordinated instruments, hybrid capital instruments, and senior debt, but at some point it also has, deposits and some other parts. And I think traditionally banks used to have different kinds of, databases for each of these liability data types. But in resolution, you all need to have them all at once because you need to calculate a certain percentage that you run across all of these liabilities in order to bail them in, depending on the insolvency hierarchy. So what we've done is, we thought, okay, we need to get all of these data points and all of these, individual liability data classes together. And at the same time, there's also a requirement to do reporting to the regulator on a continuous basis so that they know that you have sufficient capacity that can be bailed in. And people who are familiar with this topic will know these ratios that are new regulatory requirements as MREL and TLAC. The acronyms aren't that important here right now, but it's just important to highlight that these are ongoing reporting requirements by the banks to the regulators. So you have this business as usual reporting, so BAU reporting on the one hand, which is an ongoing function even without the bank entering into resolution. And then you have all the resolution related one-off features. And we decided to pull all of this together into an IT tool, which we call the bail-in tool. And the way it works is you have in inputs all of the liability data classes that you have in different data sources. So they all get sourced into one new platform. You also have to source additional data points that are required to calculate these regulatory ratios, MREL and TLAC. So these are the denominators that you need for the calculation of these ratios. And you have certain other data points that are required in this bail-in process. So you have to identify the right feeds, and all of these feeds get then basically onboarded on the central reporting or the central database. Now you have several functions that you need in order to produce the output that you want. So you want, on the one hand, to create these reports for MREL and TLAC reporting. So you have to do these calculations. So that's a certain functionality that you have to include in this bail-in tool. But then you also have to do the carve-out of certain liabilities that are included. Some of them are excluded of bail-in, and so on. So in essence, this bail-in tool is an inventory of all your liabilities. And depending on the function you need, so whether you want to calculate it for one of these ratios, or whether you want to use it for the bail-in calculations, you just take different haircuts and different, let's say, weightings for each liability class, and then also for each liability instrument. So ultimately, you have all of these thousands of, and if you include deposits, even potentially millions of data points. They're all in your system, and then for each single one, you can basically calculate what the write-down percentage should be and how many shares to allocate to this individual instrument. So that was the first work stream on the reporting side. The second work stream that we have is what we call financial valuations. And for those that are familiar with the entire resolution process, this is also often referred to as Valuation 1 or Valuation 2 as part of the resolution framework. And ultimately, the challenge here is that when the bank enters this resolution weekend, you need to really know what is the financial position of the bank. So what are the losses, what is the balance sheet, what is the risk position, what is the capital position, and so on. And if you ask banks, typically they will tell you that they are usually able to give you the exact number on what the financial position is only for one day a month, which is the month end. And typically banks have a process to calculate for each month the exact numbers for the P&L and so on. And for everything else, they tell you it depends on certain businesses. For trading, for example, some have daily P&L data, but for certain other businesses that are not as volatile, they only have weekly data or whatever. And the challenge is that in a bail-in situation, this can happen on any day of the month. So it can happen on the 12th, on the 19th, or on the 22nd, essentially. So we had to change our current processes to a way that it can be done any day of the month, and it has to be done very quickly. So we currently had in the bank, or we have a process in the bank, which is the flash process, and many banks also have that, which means that within an accelerated manner, banks calculate what is the P&L number for the end of the month before you have the actual number, which comes maybe 2 weeks later. So this flash process can take a few days, and we try to accelerate that to basically 24 hours. Yeah? So this is a lot of effort, but it also gives a lot of insight about the processes that you have normally in the bank. And so by looking at the existing process, by looking at the existing data architecture and infrastructure, we managed to come up with a refined way to condense this into a one-day process which can run on any day of the month. So, this just gives you some illustrative overview, but essentially you have to collect data on risk-weighted assets. By divisions, typically you have to collect data on revenues, for which you have to also do the tax overlay. Cost numbers are usually done on a group basis, not by divisions. And then also you have to look at the balance sheet for each division, and that also feeds into leverage data. So all of these points have to be collected and then ultimately aggregated and consolidated, and potentially also estimated with some adjustments, where you get then the final output. But I think this is going to be one of the key challenges for banks to streamline the processes, that they're able to generate data very quickly. And we've been able to do that, but with a very long timeline and quite some changes to our infrastructure. And we've actually done a test in the end of March to see whether this process works or not. We compared it with the March numbers, the actual numbers and the flash numbers, and the result was actually quite good. So it's possible, but it does take some time, and it definitely needs a lot of involvement from senior management and commitment also on the IT side. Next is the workstream on economic valuations. So in comparison to the financial valuations that we just heard, this deals more with the, let's say, franchise value of the bank, and also the question, what is the share price, and what is the amount of shares that you have to assign to each bondholder. So the financial valuation looks more at your balance sheet and your as-is situation, but you need to find out what is really the bank worth. Because when you do a share issuance in a normal time, you also look at the market capitalization of the bank. So let's say the bank is worth, 20 billion, and you have 1 billion of shares, then of course the share price is 20 euros. And then if you do a capital increase, you just take a haircut and you issue the shares maybe at 18 or 19 euros or so. But in a bail-in situation, you need to ask yourself, what is the bank worth actually after the bail-in? So that's the post-conversion, so the market value of equity that you have after the bail-in that you need to estimate. Yeah, and that is the key component of the franchise valuation. Usually you would have an independent valuer coming in to confirm that. So that can be, KPMG, PwC, or whoever, one of these financial services firms. And you'll probably be expected to share with them your financial projections. You run a dividend discount model, and then you do some certain adjustments to really come up with the PCMVE, the post-conversion market value of equity. So what is the bank worth after the bail-in? The other component that is important is the insolvency valuation. So this is a concept that is relevant for the so-called no creditor worse off test, so the NCWO test. And that is one of the, let's say, key principles of resolution planning, where you say that the bank can enter into bail-in, but each creditor has to be better off in that bail-in process than in an actual insolvency liquidation scenario. And in order to make that comparison, you need to, of course, know what the creditor would get in a bail-in case, but you would also need to know what the creditor gets in an insolvency scenario. And therefore, you also have to run an insolvency valuation. Again, here, this is done together with the independent valuer. And there, of course, you don't have that much time, and it's all a hypothetical calculation. So ultimately, you have to think, okay, what you do with certain types of assets, how would they be treated in an insolvency case, and what is really the payoff rate for each creditor in an insolvency scenario. So once you have the financial valuation, franchise valuation, and the insolvency valuation, you can then actually calculate the conversion rates, because then you have a clear view on what the losses are, so how much in equity you have to create. You have a view on what is the bank worth, so what should be the share price. And then you actually can also see how much should each bondholder receive. So you would have to then start allocating these shares, depending on the insolvency hierarchy. So you start with the very senior creditors. So for example, bondholders would probably get all of their liabilities that are written down also in shares. Whereas, AT1 holders, for example, or Tier 2 holders, which are subordinated or hybrid capital instruments, they may actually only receive 50%, of their liabilities in new shares, and then the rest is just written down. So that really depends then on how much the bank is worth and how much is there available to be distributed to existing bondholders. There are also other discussions about what happens once the valuations are done on a final basis, because all of these, the valuations that I just explained are usually done only on a preliminary basis, because you don't have that much time over the bail-in weekend. And then you may have several weeks to do the final valuation. Potentially, this could lead to certain adjustments. I think this is an area where there's still more regulatory thinking needed about how these mechanisms can work. The next slide talks about internal execution. So this is really the question, how can you recognize the bail-in in your own systems and make sure that at the end, on paper and in your systems, the bank is a recapitalized bank and has less liabilities at the end of the day. So usually, some banks have experience with doing bond buybacks, for example, where you may do 4 or 5 bond buybacks, and then you adjust, the position of each bond in your front office systems, and that then basically trickles down into all of the other systems. But typically already that process takes a lot of time. And now imagine that you have not only 4 or 5 instruments that you have to write down, but hundreds, potentially even thousands of systems, of individual tickets and transactions that need to be written down. That is, of course, a massive challenge, and especially given the short period of time that you have. So what we've done is we looked at the business as usual process for the termination of a bond or for a write-down of a bond. And then we asked ourselves, okay, is it possible to do a bulk change, a bulk upload in our systems? Yeah. And we need to understand what development on the IT side is really necessary to speed this up. So, you may use some system, for example, Condor, or you have other systems that captures your liabilities. Potentially there's a way to do, bulk uploads into these systems that speeds things up. Yeah? And then, of course, you need to make sure that all of the data gets down into your risk and finance system, so all these things are captured right. So that is the let's say, write-down process that you need to look into. The other thing is the interest rate hedge that I mentioned earlier. So typically, banks have a hedge with each transaction. In our case, at DB, we've done an internal transaction with our, markets desk, and they then basically collect all of, they accumulate all of the hedges that we do internally, and then they do a macro swap externally to the market. But still, each single ticket has to be adjusted internally, and also with your counterpart, whether that's internal or external, you need to settle, how the cash flow changes once you have changed the swap or the hedge. And often that can also lead to a lot of complications. I think in our case, as I mentioned, we discovered that the entire process is easy as long as you can adjust each single ticket, because the risk is then essentially shifted onwards to the markets desk, and they have to deal with the change in delta positions and risk positions with the markets. But if you have a bank, for example, that does the hedges externally and also on an aggregated basis, that may lead to further complications. So that is really an issue that each bank has to deal with, and I think that may be overlooked in the general resolution planning so far. So let's say now you have done all of your changes in the front office systems to adjust the value of each bond. You've done the rehedging internally and also externally. Now you actually need to make sure that your financial accounts capture the liabilities, the capital correctly. Because you will find out, at least that was the case for us, that your equity position is actually not an instrument that is captured in any front office system. This is actually a ledger entry. And that can lead to some challenges. I guess if you have liabilities in your home jurisdiction, that may be fairly easy. So for example, in our case, a bond issued out of Frankfurt in euros, you change that down and then you have the matching amount in the ledger recognized as equity. But if you think about a situation where you may issue a bond out of Singapore, for example, in a different currency, that is then recognized maybe locally as capital, but how would you basically transfer that sort of capital recognition into your home jurisdiction where the ledger entry actually holds the entire capital of the bank? So it means those kind of, smaller details, which also need to be dealt with because, of course, it's quite key that the bank reopens, to operation and is really fully recapitalized. But it's also a case where maybe sometimes, you get stuck a bit into too much detail. So, you have to find the right balance between preparing, for such a bail-in and not doing, let's say, too much work, because hopefully this is something that will never really happen to a bank. Okay, so second to the last slide I have is on external execution. So this is the interesting point on how do you actually make sure that each bond that is held right now by all of the investors worldwide gets actually written down and then gets exchanged with new shares. And we had quite some conversations, with several external counterparties on this. And first we had to really understand how the process works for normal bonds. And that's where you come across the entire financial market infrastructure, with your Clearstream, Euroclear, DTC, all of these agents that you have out there, because they are really key, and they represent this entire network that is required to really making sure that all of these transactions are settled correctly. So in this graph, I'm just going to go through all of these steps to explain how it usually works. So typically, these orange boxes are these agents, and each issuer for bonds, but also for shares, has an agent. That can be in-house, but they can also be an external agent. In our case, in DB's case, we were lucky because they were all in-house. And so these agents are those that instruct the financial market infrastructure firms, these CSDs, to make these bookings and execute transactions. So if you buy a new share, for example, the share execution agent tells the issuer CSD, Clearstream Frankfurt, for example, how many shares to issue. It will also coordinate the cash flow coming from the investors and assigning it to the issuer, whereas then the issuer gives out the certificates, which are then allocated to the securities accounts of these investors. I think it needs to be kept in mind that behind each CSD, there's a network of these custodian banks. So if you have, for example, your Deutsche Bank bonds in this case, and you have your own bank, which is HSBC, then HSBC will write you a letter saying, there was a corporate action, and then these Deutsche Bank bonds are written down, and in exchange you have received these shares. So this HSBC is your custodian bank, and that is connected to Euroclear and Clearstream via this network that I just mentioned. So as long as the agents do the right communication to these CSDs, then the entire process flow actually works. So these share execution agents receive the instructions from the bank. They pass them on to the issuer CSD, Clearstream Banking Frankfurt, for example. They create these new shares and deliver them to the bond-paying agent. In our case, they were also in-house, but they can also be separate. The bond-paying agent then tells these bond CSDs for each single bond what is the write-down amount and how many shares should each investor receive. And with that, they also assign these shares that they have received from the share issuer CSD to these bond CSDs. And then these bond CSDs, so your Clearstream or Euroclear, they will go and say, for this Deutsche Bank bond of 1 billion, you will get 500 million cut down, but instead you receive, 50 new Deutsche Bank shares or so. And that is this exchange process. And, this basically means that the next day you open up your securities account statement, you will no longer find your 1 billion Deutsche Bank bond, but instead only 500 million and additionally, 60 or 70 shares of Deutsche Bank or whatever it is. So it's important that, banks make sure that they have the right information for these agents, which these agents can then also pass on to these CSDs. The last thing is the end-to-end process. So that is really making sure that all of these individual components that I just mentioned work together. And we have done something that we call the playbook. I think by now it's fairly market standard. So that really outlines roles and responsibility for all of these process steps and says, who does what in the situation, ideally also with a very tight timeline. So Saturday, 10 a.m., this person does that. Saturday, 10:30 a.m., another person does that in, Manila or so. And then, you have basically your roles and responsibilities assigned throughout the entire bank. What we've done in addition to this playbook is creating this bail-in tool that I mentioned earlier. And for us, this bail-in tool serves as the pivot of the entire bail-in process, because it automates a lot of the functions that we discussed before, and we've tried to use the bail-in tool as much as possible to also rely less on manual work. So in essence, the bail-in tool, as I mentioned earlier, sources all the data, and it sources some of the data points that are required to calculate the conversion rates, so the input from the franchise valuation process, the input from the financial valuation process, and so on. All goes in there. Then the bail-in tool calculates the conversion rates. So it says, this bond X will get a haircut of 20% and will receive 10 Deutsche Bank shares, and so on. All of this is calculated and is then reported. So you have the output then that is used for all the other downstream processes coming from there. So the first process is the liability write-down process. So the bail-in tool creates the instructions for that, and the instructions are delivered to the process, and then the people take over and run the entire process there. You have the external execution process where the paying agents and the share execution agents, they get informed, they receive these instructions from the bail-in tool, and they pass them on to the CSDs. And you have, of course, some information that is then communicated more widely to the public and to respective bondholders, so everyone is informed about how they're affected by the bank. So in essence, we've tried to condense the entire process into this bail-in tool, again, just to automate as much as possible. So those were the key work streams that we have, and each of these work streams, face their own challenges. And as I mentioned, this is just, DB's own experience and our own approach to these topics. And I think it's fair to say that we're still, the project has been running for 2 years or so, but we're still in discussions on some of the details with the resolution authorities to find out how it can work in practice. But I think this is going to be the challenge now for the entire banking industry to, having the right dialogue, to coming up with some standards that can really work for everyone, so that at some point the bail-in process can really run smoothly. And once really there is a bail-in application for a failing bank, everything goes well, and the resolution process is just basically, following the key instructions in the playbook. So that would be it. Thank you very much. And Ed, I would hand over back to you for the Q&A session.
Thanks very much, Daniel. That was fantastic, and I believe we do in fact have a few questions which I'd like to pass your way, and so we'll kick right off with those. First question up is as follows: is all unsecured debt bail-inable, or does the unsecured debt need to be a specific type, i.e., COC and that kind of thing?
Yeah, so I think legally all unsecured debt is bail-inable. However, it means that the bank must incur losses that are high enough that you bail in not only your subordinated debt and capital instruments, but also your senior unsecured debt. I think, in terms of the operational aspects, if it's a plain vanilla bond, that is actually fairly easy to be done. If it's a bond that has certain structures to it, first of all, it usually ranks in a high insolvency hierarchy. So typically it would be not affected by a bail-in. But if the bank is really hit badly, and also structured instruments which are in a higher insolvency hierarchy have to be bailed in, then I personally think it's also possible to deal with those. It just means that you have to look after more of the swaps elements and so on. But I think because it's fairly unlikely to have these instruments affected, the key focus right now is more on plain vanilla, senior unsecured debt.
Mm-hmm. That makes sense. Thank you. Another question here: who makes the decision that you can bail in our unsecured bondholders?
Yeah. So all of the decisions are made, of course, by the resolution authority, and I think it's important that the resolution authority has the legal power to impose the bail-in on the debt holders. So it can do this, let's say, public act, public order, and then the bank has to execute it, and all of the other agents also have to execute on that. And the resolution authority can decide, how many of these debt instruments to bail in, what the percentage should be, what the amount should be that should be bailed in, and so on. So the bank is really just executing on the instructions coming from the resolution authority. And I think that will be the key question, when will, at which point will then the resolution authorities decide to also include senior bonds in their bail-in, because that's something that we have not seen so far.
Makes sense. Okay, another question here. Is the swap market expected to function normally during a bail-in? The demand for the bail-in firm to re-hedge versus external counterparties would be exceptionally high.
Yeah, that's a very interesting point. So, we've checked this internally, and as I mentioned, it really depends on the setup of each bank. But in our case, the idea would be that all of the interest rate risk is basically moved to the markets desk. And then dealing with interest rate risk is really, the job of the traders in the markets division. And they have a lot of different instruments to deal with interest rate risk. Of course, you can do re-hedging by entering into new swap transactions. But there are also other things that you can look into, like the Bund market, the Bund futures market, other government bonds. I guess if you're a bank that is not working in euros, also on the dollar side, you have a very liquid treasury market there. And so essentially the management of interest rate risk is something that doesn't really require only doing swaps, but there are also other means to deal with that. And potentially, you could think about leaving some of the positions open because it may be right way risk. But that is really up to each bank to decide and each trading desk, to deal with that kind of interest rate risk exposure.
Follow-up question here. Is there any mechanism in place to support share price on the Monday after bail-in?
Yeah, well, I guess the key thing is to find a realistic valuation. And so that, market participants will think that, the share price is right. And of course, there will be people who will try to sell the shares, but there may also be some that think there's value in the valuation and that will try to buy the share. Our expectation is that it's going to take quite some time for the wider market to really understand the implications. Because the key thing is for the bank to reopen on the Monday morning and to continue operations. And then questions about valuations and, how some of the holders may have received shares that were not really desired, I guess that will slowly trickle in. And I guess, you would probably rely on the typical, market participants to trade the shares. But our understanding is that it should be important to really, have these shares assigned early to give markets certain, information about what the valuation was for the independent valuers and for the resolution authorities.
Okay. And so we said losses need to be high enough for unsecured bondholders. Can this value be quantified?
Yeah, that depends on every single bank. So you have to look into the liabilities and capital structure of every single bank to understand how likely you may be affected as a senior unsecured bond investor. So if you have a bank that has a lot of capital and has a lot of subordinated instruments, then it's of course rather unlikely that your unsecured bonds will be bailed in. But if the bank has a very thin capital structure and is relying mostly on senior unsecured bonds for its bail-in capacity, then it may be more likely to have a bail-in of these unsecured bonds. But therefore, you would have to analyze each single bank separately. But once you look at the balance sheet structure, you could certainly quantify the kind of losses that would be required to get also senior unsecured bonds affected.
Okay. We had a tweet come in during your presentation. It might be something you can shed some light on, but I'll ask you anyway, not to worry if not. But the question here is there a market for quanto swaps?
Okay. I'm not familiar with that term. So I don't think I'm actually
no worries.
able to answer the question. I'm sorry.
That's fine. I think it's one of those that might have just come out of Twitter. I thought I'd ask and see if it was something you might be able to. I'm sure someone out there might be, so we can retweet that, no problem. But I've got another question here. Given the challenging timelines to write down the unsecured debt, there are bound to be some write-downs that fail or less than accurate to being applied. Have you thought about the legal ramifications of some pari passu debt holder being in a worse or better off position post bail-in?
Yeah, so I think we have to distinguish between two things. One is the legal public order that is issued by the resolution authority, which will really make bail-in effective. So once this is published, and we expect this to be done on a Sunday evening, for example, and the resolution authority then announces that, bondholders XYZ will receive a haircut of, this and that much percentage, then legally that's already effective. The execution is then just basically following on from the, legal position. But, if the execution isn't done correctly, you of course still have the right to change, your bond or to get this basically reclaimed. So it's important to note that what is really valid is the legal public order. So therefore, I think if there's an issue on the execution side, then of course there should be some mechanisms to compensate for that. The other question is what happens with actual challenges to the legal public order, so the conversion rate that is set by the resolution authority. And again, I think, there should be some grounds to challenge that. We've just seen last week that, for the Banco Popular case in Spain, there have been investors that have now also challenged the valuation and challenged the entire process. And it will be interesting to see whether they will be successful. But I think, while it's, there should always be legal grounds for people to challenge. If the analysis is done correctly, and the amounts are basically in line with the overall resolution objective, then I think it would be very difficult to challenge those, because, ultimately the bank will have to be recapitalized, and that's also for the sake of stabilizing the financial system.
Okay, great. Just time for a couple more maybe here. I've got another question here. Is it realistic to assume that a bank is considered to be a reliable counterparty in the OTC market if it wants to hedge exposure in a bail-in situation?
Yeah, so that's what I just mentioned. There are many different ways for the bank to re-hedge itself. Certainly, as I mentioned, if you deal with, the Bund future market and so on, that's typically done via exchanges. So that is usually not done something on the OTC side. Whether the bank is a credible counterparty on the OTC market, I would actually say yes, because, the bank will be recapitalized, probably to a CET1 ratio of 16 to 18%, which, would just mean it's a very, very safe and solid bank, and therefore it should be extremely unlikely that the bank will fail again. So if there are any concerns on the credit side, hopefully that will also give counterparties sufficient comfort to say that this is a counterpart that the bank can deal with.
Okay. And just to wrap up, final question. What has been the guidance from the regulators / resolution authorities for bail-in planning? Clearly they must tell the banks what to do, right?
Yeah, so that's actually a very good point. So, of course, you would usually expect the regulators to tell the banks what they should do. And I guess in this case, they have also been saying that banks should make bail-in work, so they should make bail-in operational. But I think the problem is that bail-in hasn't been tested before. So there's really no precedent you can refer to that gives regulators or banks or anyone in the market sufficient comfort on what the standard should be. So therefore, in our case, this has been a long journey where we have been working very closely together with the regulators and resolution authorities to come up with certain principles, certain ideas, and of course there's always a challenge and a confirmation on both sides. And that's how we ended up with this entire process that I mapped out in this presentation. But I think it will take quite some time, before you have, market standards that then regulators can really basically give banks to say, so these are the standards, go implement them. I think, it will still be, a few years down the road from here.
Great. Makes a lot of sense. Well, listen, that's all we've got time for. So thank you very much, Daniel, and thank you to everyone who joined us for the webinar. If you do have other follow-up questions that you think of, we will happily forward those on to Daniel, and we can get you an answer. And we will also be sort of forwarding around some of the other webinars that we've been doing. So keep an eye on your inbox for those. Daniel, we look forward to seeing you at RiskMinds International in December at the conference itself, hopefully, as well as some of your colleagues who'll be there. And that event is taking place December 4th to 8th in Amsterdam. But if you've got any feedback on today's webinar or any recommendations for future webinars, do complete the short survey, which will flash up on your screen shortly. Please do keep an eye out, as I said, on your inbox, and we hope to keep in touch.